deciding how to remove funds from a small or medium enterprise, that sounds really clunky when you say it like that, from an SME. It's not the direct responsibility, of course, of a financial planner, but financial planners are often involved in the process together with an accountant and add great value. The main choices, of course, for removal, for use by the business owner, who will also be a director, emerge from the fact that they have two capacities, effectively as an owner of the business and a shareholder, and therefore the amounts that they will take to reward them for that, for their investment, will be a dividend. And as a director, probably also an employer, will be receiving a director's fee or pay, basically, and they are the two main choices. Ahead of that, or maybe alongside that, there is, of course, the way to extract money from a business directly for the benefit of the shareholder director. Both of those other means of extraction, of course, have tax consequences, whereas moving money directly into a pension fund for them has no tax consequences other than good ones. Of course, the pension contribution is fully deductible for the company, subject to the usual conditions being satisfied, and there will be no tax implications at that point for the director shareholder who receives the benefit of that contribution into their pension fund. As my colleague Claire Trott, a pensions practitioner extraordinaire, says, but you can't eat a pension. Okay, so with that very firmly in mind, let's confine our choices to dividend or salary. And it's a perennial thing, and you think, what are you talking about this again for? Because we know basically the rule is dividends win, and that will pretty much continue to be the rule, but it's really, really important to remember and note that the drivers to those to that decision making, underneath that decision making, dividend or salary, are changing, and the gap between dividend and salary is narrowing, and perhaps not surprising, because it does seem HMRC have kind of got it in for dividends and have had it in for dividends over a number of years. So the main sort of moving parts, the main drivers in decision making, corporation tax, often forgotten that, because of course a dividend is the amount that's available in a company. A dividend comes from the amount available in a company to distribute after corporation tax has been deducted. By definition, effectively, it's after tax profit. And then we've got income tax, of course, which is what will be payable on receipt of the dividend or the salary or bonus, and then national insurance, a subject very much in the news, which is relevant for a receipt of salary but not dividend. And corporation tax, of course, relevant, as I mentioned, for deciding how much is available to pay by way of dividend, and relevant also because a payment of salary or bonus would usually, almost always, be deductible for corporation tax purposes. So what's changing? Okay, what's changing is we know we have a corporation tax change, which we expect to be implemented fully in 2023, tax year 2023. And that will move corporation tax up to 25% for profits over 250,000. It remains at 19% for profits below 50,000. And there's this marginal rate that we'll have, which will move the average rate up from 19 to 25 on profits between 50 and 250,000. And we all expect that marginal rate to be in the order of 26.5%. Income tax, no change. And I suppose that's the change, in that we're not having any changes to rates or allowances, because we have that freeze on until the end of 2025-26 tax year. So that's going on. And then we've got national insurance changes, very, very much in the news, aren't they? Because those NIC increases are due to kick in with effect from tax year 2022-23. And that's where there's a lot of discussion going on at the moment about the rightness of that, given the cost of living challenges that we have. Right, so if we just look at the numbers underneath these changes, and I'm going to have to put glasses on for this, then we can see, it's a good way, we can see, but it's also a good way to look at, okay, how does this all pan out with all of these moving parts in, these changes and freezes? What does it mean for the comparison between taking money out of your business by way of salary or by way of dividend? Okay, this first slide on extraction shows the position for a director who is a basic rate taxpayer. So for the current year, which we're just about still in, then you can see that with a standard corporation tax of 19%, that the bonus will yield you £597.53, and the dividend will yield £749.25, which is more. Of course, when we get to next year, we'll have those NIC changes, and the bonus will yield you even yet less. But you've also got a dividend tax change, which impacts, but not quite as much as the national insurance change, because the national insurance change is an increase of 1.25% to employers and to employees, national insurance, whereas the dividend change is 1.25% extra, but 1.25%, not two of them. So 1.25% instead of 2.5%, which means that the gap widens a little so that dividends become more attractive next year. Bear in mind, we still have a 19% corporation tax rate. When we get to 2023-24, then for the 19% corporation tax rate, the position remains the same because you've got the same amount of money left to distribute by way of dividend. But at 25%, we've got slightly less left available to pay out by way of dividend. So while the dividend is still gives you more than the salary, it's not quite as much. And when we get to 26.5%, it's even less because you've suffered even more corporation tax, but still better. So the outcome of all that is, right, dividend or salary for all those years for a basic rate taxpayer remains dividend on pure commercial after-tax grounds. And if we look at a higher rate taxpayer, I'm not going to laboriously go through all that background stuff again. We can see that the upshot basically is that dividend remains the winner throughout this year and next year and going forward after the corporation tax change, after all those moving parts have been implemented. So dividends win again. Could go into a ABBA song there, is you win again to the dividend, but I'll spare you that. Next and last is the additional rate taxpayer. And here there is a small change because of the corporation tax rate and the additional rate of tax combining to go, actually, once you get to 2023-24, and if you are in that marginal tax rate area, profits between 50,000 and 250,000, what we will see is that the dividend, for the first time for many years, for an additional rate taxpayer receiving a dividend from a company that pays the marginal rate of corporation tax, if you're in that position, then the amount you receive by way of dividend, drum roll, will actually be less than the amount that you receive by way of bonus or salary. That's the first time for many years. We're not there yet, and a lot could happen between now and 2023-24, but based on what we know now, that would be the position. So all of that, interesting, of course, as it is actually really, really important to keep in mind and to have those really strongly informed, granular decisions with your companies, proving the value of your know-how, your contextual know-how, and especially proving reputation with professional connections. All of this, of course, is covered in detail in Techlink.